Greetings everyone, and welcome to AAA Trades. In today's session, we'll be delving into the charts of Bank Nifty for August 18, 2023. This isn't your typical post-market report. Rather, we're here to meticulously examine these charts using order flow analysis. This marks a continued chapter in our journey of mastering order flow, with more insightful content to come. So, I encourage you to watch this video in its entirety and consider subscribing to receive notifications for upcoming videos. Let's begin by examining the events of August 18, 2023. The opening stood at approximately 43,725, while the closing settled around 43,695. However, our focus shifts to the initial 3 to 4 candles, comparing their movement with both order flow charts and the conventional charts visible on platforms like Zerodha or TradingView. Observing the order flow chart for the first 5 minutes, we notice the presence of stacked orders. In the subsequent 5-minute candle, a swift rise of about 80 points occurred, ranging from 43,930 to approximately 44,050. Determining the appropriate course of action, whether to buy or not, brings us to the daily charts. Turning our attention to the daily chart's perspective, the commencement of the chart revealed robust buyer cover orders. These cover orders enveloped the preceding day's orders within the first candle, driving the price down briefly to 43,800 before rebounding to 43,935. This maneuver signaled the opening volatility. Subsequently, the second candle displayed volatility stemming from the initial candle. Now, shifting focus to the second candle's progress, we observed a continued upward momentum. This pattern persisted in the third candle as well, while the fourth candle took the form of a doji, warranting confirmation through the order flow charts. The order flow charts should align with our analysis, indicating the trend's validity and potential. Let's delve into what transpired within this context. This involves the 5-minute candle, with the first one signifying the 5-minute duration. Notably, this 5-minute candle concluded at its peak, implying a markedly bullish market sentiment. As we observe the COT and the COT ratio, we note a COT ratio of 4.92. Analyzing the first 15-minute candle, the commitment of traders on the buy side reached 1072. Yet, upon examining the second candle, this number dwindled to just 45. Transitioning to the 5-minute chart, after the initial 5 minutes elapsed, the COT plummeted to minus 121,291. This indicated a negative trend, despite the green candle appearance. Evidently, the green movement resulted from cover orders being executed. These cover orders were the consequence of previous day orders that had been established on the preceding day. Those who had sold on the prior day covered their orders here. This necessitated their purchase, ultimately closing their positions. This is precisely why the market surged within the first 5 minutes. This was reinforced by the negative delta, despite the candle's upward trajectory. This suggested a prevalence of cover orders, along with fresh sell orders trapped due to both volatility and rapid price fluctuations. Continuing the discussion, the subsequent candle also displayed upward momentum, underscored by substantial orders. Within this second candle, there was a notable instance of partial buying. The delta stood at 1568. However, focusing solely on the buying side's COT, it amounted to 1713. Notably, the most remarkable change occurred in the minimum delta within this second candle. It initially reached a value of minus 100, before surging to a remarkable plus 1568. This profound shift underscored a significant market move, which could also be monitored through the price chart. This also pertained to options pricing, particularly relevant when considering specific strikes. This momentum persisted, culminating at approximately 44,100. However, we chose to exit the trade around 44,050 due to the presence of a doji candle. The doji candle, often an indicator of market indecision, prompted this decision. Without this, we might have maintained or even increased our position. It's important to highlight that post the doji candle or any head and shoulder pattern candle, we did not make the decision of exiting the trade. Rather, our trading was guided solely by the data available. This primarily encompassed the number of buy and sell orders, alongside their associated imbalances. If the imbalance was pronounced, it prompted us to trade in that corresponding direction. Now, let's delve into the events that transpired during the latter half hour to 1 hour, beginning from 2:30. It's important to observe what unfolded during this time frame, which will also cross-reference with the order flow charts. If we focus on the timestamp of 1320, a clear reversal in the trend becomes evident. This shift initiated a period of sideways movement that persisted from around 1:30 to 2:30. Subsequently, momentum started to build from 1:30 onwards, peaking at 2 o'clock. This specific juncture serves as a pivotal decision-making point. It marks the candle that guided our choices. When comparing it to the previous candle's delta, noteworthy insights emerge. The previous candle displayed a buying side delta of merely 127. In contrast, the subsequent candle showcased a substantial surge in the selling side's buying delta of reaching 683. This stark contrast highlights a significant imbalance favoring the buyers. This imbalance acted as a critical trigger for us to enter the trade. Analyzing the ensuing candle, although it was red, the delta remained green, clearly indicating a strong buying momentum. This is evident from the visual representation of the delta below. This specific candle symbolized pure buying. The subsequent candle witnessed a skirmish between buyers and sellers, with sellers attempting to drive the price down through a delta of -282. Despite their efforts, they didn't achieve success. The next candle in line also displayed trading activity, yet it didn't yield favorable results. However, it was the fourth candle post the confirmation candle that brought about a vigorous upward surge. This propelled the market upwards by 80 to 90 points, originating from the exact juncture where we identified the pivotal, deciding candle. This particular candle represented pure buying sentiment. This trajectory is often indicative of fresh buyers aiming to maintain the market above this level to evade losses. Consequently, We exited the trade around 44,050 or 44,060. Subsequently, another deciding candle emerged, immediately heralding a trend reversal. Taking into account the chart ratio and the commitment of sellers ratio, a significant disparity becomes apparent. The commitment of sellers ratio stands at 49, while the corresponding ratio for the buying side merely reaches 0.02. This discrepancy emphasizes the prevalence of sellers, with a considerable gap between the two sides. This is the COT ratio, CR. On the buying side, the figure is even lower at near zero, a mere fraction of the selling side. In continuation, the market embarked on yet another reversal, leading to a decline towards the previous point of 43,930. This sequence of events provides a comprehensive snapshot of the fluctuations and trends within this timeframe. Upon closer observation, a period of slight sideways movement is discernible. This period coincided with an intense struggle among various market forces. Notably, a substantial delta candle emerged on the downside, exerting significant downward pressure and guiding the market toward 43,930, precisely where a trade was initiated. Intriguingly, traders often refrain from immediately entering a fresh trade after exiting a previous one. Yet, the subsequent candle promptly suggested a trade akin to the previous one. This trade endured for a longer duration, spanning approximately 8 candles. In this phase, the market displayed a robust downtrend. It's interesting to note that while the earlier upward movement encompassed only 5 candles, the subsequent downward trend required around 8 to 10 candles to complete. This showcases how order flow analysis empowers us to decipher numerical cues and execute precise trades. Our approach revolves around taking just 1 or 2 trades per day, predicated on the prevailing trends. Directing our attention to specific price levels, those marked earlier hold paramount importance. They represent potential turning points. This concept mirrors what traders often refer to as a doji, head and shoulder, or inverted hammer, a point where price breaches a significant level but ultimately faces rejection. This forms a crucial trap that attempts to breach a crucial level, only to be met with resistance. Notably, when the trend reverses, it often does so precisely at the same juncture. This correlates with the trade we executed at the end, where the reversal coincided with the original entry point. This underscores the significance of these levels. I intend to identify such levels and gauge how frequently they are revisited. Generally, smart buyers position themselves at these levels to steer the market in their favor. Similarly, if smart sellers exist, they may drive the market downward. To elucidate, these smart sellers are situated in a supply zone, endeavoring to keep the market suppressed. Conversely, a support zone or demand zone is established beneath, reflecting the space where a minor demand surfaces. Within this framework, the notion of trapping sessions comes into play. Certain price levels are repeatedly touched, an occurrence analogous to a trap being sprung and the market recoiling to its previous state. The concept of support typically resides within the range defined by support and resistance levels. Identifying these levels is best accomplished through chart analysis rather than relying on lagging indicators. Indicators tend to generate signals only after data has been available, rendering them less immediate and insightful. Consequently, the importance of these levels cannot be overstated. Additionally, it's advisable to also consider longer timeframes, such as 15-minute or 60-minute candles, to ascertain the market's direction. Recent market behavior has featured sideways movement over the past 2 days. While not entirely stagnant, there's been a touch of volatility. Notably, the overall trend has been downward. However, the challenge now is to break through the newly established demand zone that emerged earlier. Market participants within this demand zone are striving to maintain upward pressure. Consequently, it's crucial to monitor whether sellers will intervene, potentially pushing the market downward. It's vital to recognize that the marked line represents the demand zone. Therefore, the market must surpass this threshold. The support and resistance levels, often referred to as the demand and supply zones, respectively, are strategically positioned by traders, whether they are smart buyers or sellers. Embracing order flow offers a distinct advantage, as does utilizing plain charts. This approach goes beyond mere fixation on the candle's fluctuations. Instead, it delves into the underlying reasons for its upward or downward movement. By analyzing past occurrences at particular junctures, we can anticipate future developments when those points are breached or altered. Incorporating simple, plain charts involves drawing lines to denote these significant levels. This approach doesn't rely on indicators but rather utilizes the data provided by order flow, as previously demonstrated. The relevance of order flow data in trading cannot be overstated. Without this data, trading is akin to speculating, and such speculation can lead to errors. In forthcoming discussions, I will delve into the reasons behind speculative errors, particularly in the initial 15 minutes of open market action. This period often marks the creation of a unique zone and will serve as a focal point for further exploration. In the upcoming videos, I'll delve deeper into the concepts of demand and supply zones. You can also expect more comprehensive insights into support, resistance, absorption, distribution, and other related aspects. We'll stick to a straightforward approach, avoiding unnecessary complexities and irrelevant elaboration. My focus will remain on what truly matters, guided by my methodology. It's crucial to remember that this content is intended solely for educational purposes. Your analysis of charts may vary, but the goal of making informed trades, minimizing losses, and maximizing profits remains consistent. The strategic advantage of order flow lies in the ability to maintain very tight stop-loss levels. For instance, in a trade where we set a stop-loss of just 5 to 6 points, achieving such precision would be considerably challenging without the aid of order flow charts. This advantage becomes evident when you consider that the stop-loss level is often the high of the same candle where the trade was initiated. This minimizes potential losses significantly. In fact, you'll notice that stop-loss levels are rarely breached when the trade is well-timed and executed with the insights provided by order flow. This level of accuracy, around 98% of the time, contributes to profitable outcomes. Should you have any questions, feel free to message me or drop a comment, and I'll do my best to provide a prompt response. If you find the content beneficial, I encourage you to subscribe to my channel. By doing so, you'll gain access to more in-depth discussions on this subject, including fresh content tailored to your requests. That's it for now. Keep watching. Embrace the world of trading, and remember that the power of order flow extends across various market segments, including gold and others. The chart displayed earlier showcased Dixon futures, offering valuable insights into market dynamics. While obtaining such data isn't freely available, I'll be happy to guide you on where to acquire it. Bear in mind that this comes at a cost, including software expenses. However, I believe the investment is worthwhile. To clarify, I'm not endorsing any particular software or acting as a brand ambassador. I'm personally using a software I find effective and helpful. Should you choose to explore it, you can utilize order flow charts like the one shown earlier, which played a role in a significant trade of 1,800 points on Dixon. If you're interested in acquiring the software or data, you can reach out to me through the provided contact details. Feel free to stay engaged in the comment section, as your feedback helps me create better content. Remember, this resource is provided to you free of charge. I understand the hesitation to invest heavily in courses. While others charge substantial amounts for lengthy courses, I'm committed to providing essential, practical insights. Learning about order flow charts is simpler than you might think, and you can master it within a reasonably short time frame. Thank you for tuning in, considering subscribing, and stay tuned for more valuable updates.